Okay, so what is the purpose of an audit? The AICPA is laid out in AUC section 200.04 what the purpose of an audit is, and so the purpose of an audit is to provide financial statement users with an opinion by the auditor on whether the financial statements are presented fairly in all material respects in accordance with an applicable financial reporting framework, which enables or enhances the degree of confidence the intended users can place in the financial statements. And so an audit conducted in accordance with generally accepted auditing standards and relevant ethical requirements enables the auditor to form that opinion. Now, they've been very specific with the terms they use and the terms that they do not use in describing the purpose of this audit, and it makes this be a very specific and narrow definition. So first they say here that it's to provide financial statement users the information. So when designing the strategy and procedures for the audit firm needs to understand who these financial statement users are. That way they can determine what's important to these users and develop their strategy and procedures based on the needs of those financial statement users. And we also see here that the purpose of the audit is to provide an opinion. That's it, no more, no less. It is to say yes or no, pretty much. It doesn't say prepare the financial statements, correct all misstatements, be the bookkeeper, etc. It says merely provide an opinion. And this opinion is whether the financial statements are presented fairly in all material respects. So first here we have presented fairly, and this means that all the rules have been followed according to this financial reporting framework, and we'll get to that in a second. But most importantly here, they say in all material respect. Now this means that the auditor isn't expected to find every mistake or misstatement. It's merely to find any mistakes, errors that would alter a decision of the financial statement users had they known about this error or mistake or misstatement in these financial statements. And materiality has a section all of its own, but it's a very subjective term that takes a lot of judgment on the auditor's part as far as how qualitatively and quantitatively what things are material and what things are immaterial. And next we have with the applicable financial reporting framework. So it doesn't say, you see, it doesn't say you have to, or the financial statements have to be in line with a certain framework, for instance, GAAP or IFRS or whatnot. The auditor is merely saying yes or no, is this financial statement in accordance with a financial reporting framework that is often decided by the financial statement users. So some financial statement users might prefer these financial statements to be in GAAP, others might prefer some sort of other comprehensive basis of accounting, for instance, cash basis or tax basis. But the point here is that the auditor is providing an opinion on whatever financial reporting framework the financial statement users are preferring to use. And so all of these things together basically summarizes that the procedures and strategies developed by the auditor should enhance the degree of confidence that the intended users can place in those financial statements. So that's kind of the end goal of the auditor. But due to cost and timing constraints on the auditor and the company he's auditing and the financial statement users, we could never obtain absolute assurance that these financial statements are free from misstatements, and that's why we have here material in all material respects. And that way we get an efficient and effective audit that achieves the goal of doing the audit in the first place. And so to make sure this goal is achieved, we follow a set of standards called Generally Accepted Auditing Standards, or GAAS, and these are promulgated by the AICPA and also some ethical requirements. And by following these standards and requirements, the auditor should be able to form that opinion with a high degree of confidence. And some other important points to be made here. This opinion is being made on these financial statements alone, and that's it. So this opinion isn't saying the future viability of the company is secured or whether management has done a good job of executing the affairs of the company and its assets. It merely says that it's materially likely that the financial statements are accurate as presented in accordance with this financial reporting framework, and then the financial statement users can decide all of the other situations that we just suggested based off of the information in the financial statements. And now the audit doesn't just have to be on the financial statements. Audits can be done on other matters as well, for instance, compliance with rules or regulations or contracts of the company, or whether internal controls have been designed and are operating effectively. And so although GAAS sets forth standards for determining the results of those types of opinions. They're merely to help in the risk assessment process for determining procedures for the financial statement audit, and not necessarily to provide an opinion to users on, for instance, the internal control or compliance with laws. The standards for those items will be found elsewhere, for instance, for compliance with laws and contracts, potentially government published laws and such.